Read the mainstream financial press today, and you will find a consistent narrative. Corporate sustainability is rapidly retreating in the face of intense political backlash. The volume of consumer-facing environmental messaging has visibly dropped. Recent GlobeScan data shows that public brand message visibility around sustainability has fallen from 49% down to 36%. But this silence masks a contradiction in how U.S. enterprises allocate capital. This EcoVadis chart compares declining ESG headlines against rising corporate procurement expenditures. 87% of surveyed corporations maintained or increased their sustainability budgets. The capital is still flowing. External macroeconomic data confirms this operational resilience. Morgan Stanley recently found that 88% of global companies view sustainability as a long-term value creation opportunity. Analytical. To understand the discrepancy between high internal spending and low public promotion, we have to look at a behavioral trend known as greenhushing. This calculates the cumulative rate of corporate silence. We start with 31% of organizations increasing investments while reducing communications. Add 8% executing budgets but stopping communication entirely. This yields a 39% greenhushing rate, mathematically corroborated by MIT Sloan. Corporate sustainability has not died. It has strategically decoupled from public relations to become a shielded operational asset. The driving force behind this silence in the United States is a hostile political landscape that has turned public disclosure into a legal hazard. Conservative state legislatures have filed and enacted dozens of bills designed to punish financial institutions and corporations that integrate non-financial, environmental, or social criteria into their business models. Specific state-level mandates in Florida and North Carolina now explicitly prohibit public pension fiduciaries from considering ESG factors in their investment decisions. Equivalent measures in Texas have actively penalized major financial underwriters accused of boycotting fossil fuel firms, forcing several institutions to exit municipal bond markets entirely. This political hostility has created a deep chilling effect. Prominent asset managers like Larry Fink of BlackRock have completely scrubbed the term ESG from their public investor communications to avoid partisan litigation. Beyond regional political friction, multinational firms are navigating an overarching global regulatory crackdown on deceptive environmental marketing. The U.S. SEC's Climate and ESG Task Force has pursued high-profile enforcement actions, securing multi-million-dollar settlements against multinational corporations for making misleading statements about their safety audits and investment processes. Simultaneously, the Federal Trade Commission has systematically tightened its green guides, enforcing strict substantiation requirements for any corporate environmental claims. Internationally, Canada passed Bill C-59, exposing corporations to severe financial penalties, up to $10 million or 3% of global revenue, for making claims that lack internationally recognized methodologies. In the United Kingdom, regulators have deployed AI-based active ad monitoring systems to automatically scan and reprimand global brands for using broad, unsubstantiated superlatives regarding sustainable materials. A critical regulatory shift has occurred. The burden of proof now rests entirely on the final seller, stripping public disclosure of its commercial upside. Massive legal liability combined with zero commercial gain creates a highly asymmetrical risk profile. Corporate legal counsels are looking at this math and mandating complete radio silence to protect the firm. These external political pressures have fractured internal corporate hierarchies, creating a structural divide between the boardroom and operations. According to data from the Conference Board, 38% of U.S. CEOs are now publicly declaring that sustainability is not a priority for their organizations. This CEO sentiment is a direct reaction to immediate political scrutiny and the competing administrative demands of rapid artificial intelligence adoption. But operational leadership tells a different story. 65% of surveyed executives define sustainability as an operational asset that accelerates growth through risk mitigation and structural cost savings. Supply chains operate in a volatile macroeconomic reality. 76% of food executives report being forced to alter pricing strategies and reevaluate supplier networks due to tariffs and severe weather disruptions. In this environment, auditing supplier labor conditions and tracking carbon intensity are essential practices to ensure basic business continuity and satisfy B2B procurement requirements. Corporations naturally do not issue press releases for standard risk management practices, which accelerates the transition to quiet execution. A dual corporate reality now exists. Public boardroom neutrality acts as a political shield, while procurement teams quietly build out compliant, low-carbon supply chain infrastructure. But intent and investment do not equal actual regulatory readiness. Only 13% of surveyed companies are actually on track to comply with upcoming mandates, like the EU's Corporate Sustainability Reporting Directive. The corporate sector faces a massive data deficit. 33% of executives admit to knowingly reporting unverified estimated ESG data just to satisfy immediate commercial expectations. In response, writing platforms like EcoVadis are eliminating score rounding and tightly restricting document submissions to force suppliers away from simple documentation and toward verified execution. To replace unverified PDFs, U.S. companies are rapidly deploying supply chain mapping technologies. 57% of firms utilize ESG risk mapping tools, and 49% deploy supplier engagement platforms. But a blind spot remains. Only 18% of firms track Scope 3 emissions. This gap is severe. Supply chain emissions are, on average, 21 times higher than a company's direct operational emissions. Failing to manage these indirect upstream emissions exposes S&P 500 corporations to over $500 billion in annual financial liabilities by 2030. Relying on estimated data and ignoring Scope 3 exposure renders any corporate greenhushing strategy legally indefensible when actual regulatory audits commence. Widespread corporate silence carries severe macroeconomic consequences, actively stalling the momentum of global decarbonization across all major industries. When leading organizations go quiet, competitive benchmarking is diminished. Industry laggards face less pressure to improve their environmental baselines, slowing the overall pace of transition. In the financial markets, absolute silence causes ESG-focused investors and credit rating agencies to misallocate capital because they cannot distinguish genuine market leaders from standard opportunists. Corporate leaders recognize these risks. 47% of C-suite executives warn that rolling back ESG regulations will actually increase supply chain disruptions and raise consumer prices. Corporations must adopt managed transparency. First, verify documents. Public claims must map to authorized data. Second, replace subjective terms like eco-friendly with exact quantitative metrics. Third, frame sustainability as an ongoing transition to build regulatory credibility. Fourth, translate environmental risks into operational resilience metrics. The corporations poised to thrive through 2030 are those that completely abandon performative marketing, treating sustainability exclusively as an auditable, verified component of core business intelligence.